All right, good afternoon, everybody. Thank you very much for participating and attending once again. Today is the 7th of 9 modules, 7 of 9, so we've only got 2 left to go after today. The topic, as you can see on the screen today, is budgeting, financial reporting, petty cash management, and there'll also be some discussion around valid tax invoices and the important features of those. Just a heads up, on next week we have the debt collection process, collecting arrear levies, and there will be discussion around the role caretakers can play in supporting levy collection, which is obviously very important because those are the funds and the cash flow which buildings rely to run on and operate on. And then the very last module, the last topic for this training series, which will be on Tuesday, the 13th of October, is really just general topics and questions and answers, and we'll go through some frequently asked questions as a reminder. But if any of you have got any particular topics you'd like to recap on, any particular questions that have come up over the course, please do email those through. You're welcome to send a list, and we'll try and work through those as prompts to cover in the last module. So the last module will be a good chance to, overview all of the topics, recap on any remaining questions that you have, to address any unanswered questions you might have come across in your exposure to the course, and it'll be good to spend that time to round off on that basis. So those are the last 2 modules, which will then complete the 9-week training course, and I hope you found it useful so far. Right, we've got a fairly full session today with a fair amount of content to cover. I'd just like to introduce my colleagues who will be facilitating the presentation today. First up is going to be Dave Hershowitz. Dave is Trafalgar's National Accounting Manager. He's a CA by training and profession and experience. And Dave is responsible for managing Trafalgar's accounting teams across all 7 of our branches. So Dave's going to kick off today and deal with the budgeting and financial reporting topics. We then have Sadhna Rupchand, who is our National Financial Manager. Sadhna is based in our Durban office, and Sadhna will be covering the remainder of the presentation. And Shanith and Amina are also in our Durban internal audit team, and they'll be available for questions, and I'll be referring certain questions to them. So Shanith and Amina, welcome and thank you for participating from Durban. And then as usual, we have Karine Kutsia, our National Property Management Consultant, calling in from Durban, and Karine will be available for questions as well today. So those are our panelists today. Really important topic today, because financial management really lies at the heart of effective sectional title and property management. It's really critical to make sure that the correct costs are forecast, that we're collecting the right amount of levies, that the expenses can be paid to maintain service delivery to the building. And throughout, we'll touch on how can caretakers support this. And in many cases, caretakers are involved in signing proof of deliveries for materials, confirming service providers do work at the complex, what they will confirm, what times they are there, the correct amount of labor charge, work was done properly. So there's an important support role that all of you play in the management of creditors, the costs that are incurred by the building. You will have ideas about how costs can be saved, and it's important that you're aware of how the finances are unfolding so that the building is sustainable, that services can be maintained, and really to make sure that residents are well supported with proper maintenance, proper service delivery, and that can be effectively planned in the long term. Dave, I'm going to hand over to you then, if you wouldn't mind taking us through your section of the presentation. Thanks very much indeed.
Thanks, Andrew. Hello, everyone. Good afternoon, and thanks for making time to be with us. As Andrew said, I'm going to be going through certain aspects with this presentation. I'm going to be talking to you about budgeting, financial reporting, and petty cash management. And the first thing I'm going to start off with is budgeting. And there's a few areas I'm going to talk over budgeting, but there's a reason I'm starting off with budgeting. Budgeting, I'm sure you've heard, it's probably a buzzword. Why is there a budget? Why do we have expenses that we have to agree to budget? Why do we have to track budget? Budgeting is a very, very important process. And to start off, what is a budget? So budget itself, it's a financial plan for a defined period. What does that mean? That means we're actually financially looking at what's going to happen over a specific period. Now, we're very much used to having budgets ready for 1 year. And in some cases, you actually have budgets for 2-3 years. With the reserve fund, the maintenance fund, that's really a budget that expands over 10 years. And the whole idea is we want to see where our finances are going. So it's very important. It's a planning mechanism, and everything ties into your budgets. In our industry, we are based around our budget. We have to know what is our expenses going to be, and because these are our expenses, exactly what is our income going to be. So I'm going to just talk about a whole budget and the budgeting process. So because of the importance thereof, to do a budget properly, you have to understand all the costs involved in your complex, in your building, in your state, all the costs involved for the upcoming future, so that we can properly plan, so that we can pay for it. Financing is about cash. It's about making sure that we utilize our cash resources well. So a budget is very important. We have to know what our costs are. In so doing, when we do the whole budgeting process, and you'll see I'll put here, you need to have a good understanding of all your costs, and you need to be able to forecast and plan them accurately. So budgeting, everything involved, everything's driven around your cost structures. This is the whole budgeting idea. When we talk about, I'm going to talk about what is the purpose of a budget and the methodology, so we're understanding it. But to do a correct budget, you have to understand all your costs. Now, very important, if you can understand your costs, you can make good strategic decisions. And this is for everyone. There's understanding, okay, you know what, I've got an issue with a plumbing situation here. What costs are involved? Can I afford to do a quick fix, or can we do a longer fix? Maybe it's a piping issue, things like that. And this is where the budgeting comes in, because it allows us to plan in advance and we have the finances available. Now, very important, when doing the budgeting process, you have to understand your costs. So understanding the costs, the big important costs that happen in our industry, I've listed a few below. Security is always a big one. People live in complexes in estates because of that whole aspect that you're going to live in a secure environment. Then water and electricity, also very material and big numbers. Your utilities, what is your spend? You have to be able to pay for it. You have to be able to pay for your security, your cleaning, your accounting, and secretarial fees, because whether it's a body corporate or a state or whatever the case may be, there's always going to be secretarial and compliance figures that you actually need to be able to pay. So this is why the important thing, I've listed the common expenses, but in the budgeting, you have to understand what is going to be your plan for the year. What are your costs for the year? So when starting a budgeting process, you have to have a good idea of what is the purpose of what you're trying to do. So we said, what is a budget? It's financial planning. But let's look in our environment of the different areas of a budget. So there's components of a budget that we look at. And the first aspect is the cost. What are the different areas of our costing? And I'm going to start with, I've put them on the slide A, B, and C. I'm actually going to start with B here. So we need to understand what our obligations are. It's not just an expenditure in 3 different main areas. Our expenses are derived between admin fund, which is our day-to-day expenses. Even if I take away the fancy jargon of admin fund and reserve fund, admin fund is your day-to-day. Your maintenance reserve fund is actually a long-term capital project. And this is true for any type of estate, whether it's an HOA or it's a complex, whether you define it as an admin fund or reserve fund, we need to know what our obligations are. Okay. Now, the most important thing, so why did people interested in budgets? Every year at an AGM, we need to discuss and present what the budgets are for the year to the homeowners. And what's the most important thing that people really want to hear is how much levies am I going to pay? So this is the big component. So your levy amount, how much is actually affecting you as a homeowner in your back pocket. Then what is our upcoming obligations? And once we've identified these, this is what our purpose is we're trying to work out. We actually need to see, overall, are we solvent? So a very important idea, can we meet all our obligations? It's very well that you can have a budget for the upcoming year and you can plan what's going to be the expenditure for the year. But what if you've got bad loans and obligations that have happened in the past? And that's why it's very important that we need to understand what the purpose of the budget is. So to define the amount of our levies, to understand what our day-to-day expenses and our reserve fund expenses, and then what is our solvency position going to be. Okay, so in order to do this, there is a general methodology that is worked with budgets, and quite a simple methodology to understand. So the first thing is levies. So I'm saying here the levies are a function of the body corporate's or HRA's expenditure. What does this mean? So the approach to use when you're going to do a budget is you're going to work out what are all your obligations and what are all your expenditure. Once you've done this, you're going to make sure your levies match what your expenditure is. So that's why I say it's a function of your expenditure. Your levies are there to cover your expenditure. And this is the methodology we do. So then we divide it. Okay, so we've got day-to-day expenditure, called our admin fund, and we've got reserve fund expenditure. So to work out the methodology of what the admin fund is going to be at the end of the day, we calculate all of our expenses, and then whatever our expenses are, we want to make sure we get the income coming in. So through the levies, we want to make sure that comes in. So the approach that we take is called a break-even approach. That means all your inflows, all your incomes that you get will match your expenses. And that's for your day-to-day. You want to cover it. You're not there to make a big profit. We're not a trading industry or trading company, retail, nothing like that. We want to cover the expenses that are required for the state or the body corporates to carry on running in the future, to be financially viable. Then the reserve fund. So what's nice with the reserve fund, and obviously this relates more to sectional title, is that it's actually requirements for a reserve fund. There's a minimum requirement, which is usually about 15. There's different categories, but the minimum is 15% of whatever levy you are proposing. And then there's also 10-year plan requirements. So you actually, this is all legislation, so you actually have to have a 10-year plan, and that's going to govern what your actual expenditure is going to be in the future. So your methodology around your capital expenditure is governing what your 10-year plan is. And then the idea is whatever you know you have to spend, you're going to try raise via levies. And then ultimately at the end of the day, and I've put in financial position, this means, can you cover all your expenses? Are you going to be solvent? And again, if you remember what I said, the purpose of your budget is to be solvent, and you're going to derive your methodology when doing your budgets around being solvent. So we've got the budgeting. We understand there's a lot of costs involved. We're making a financial plan for the upcoming year, for the future. How do we go about doing it? And there's a timeline involved. Everything revolves around your financial year end. So if I were to work backwards, at an AGM, that's where you ultimately approve a budget. However, in terms of the Sectional Title Act, you can get a 10% increase on the first day of the new financial year. So my best practice timeline, my advice to give to you when going through the budgeting process is you want to do it as early as possible so that you have a budget ready by the time of the new financial year starts. So as you can see, I've said you want to start the process 2 months before year end. So 2 months before year end, you're going to sit down with the trustees, the accountants, everyone, to start understanding what is the budgeting, what are the needs for the new year. So you're going to start your computational calculation of the budget. Then what you're going to do is you're going to try, all the meetings are going to be contracts. Remember all the list I told you about the different expenditures, there's security, there's cleaning. You're going to be looking at those contracts. You're going to see, are the increases needed? All those type of ideas. Those are going to happen before year end. And the whole idea is that by year end, before it starts, it's actually been approved by the trustees so that if need be, you can actually get the 10% increase at the beginning of the year end. Now, times are tough at the moment. Our economy isn't the easiest. So a lot of what I'm seeing, the earlier you can get that first increase in, it helps so much down the line with the finances of the business, of the body corporate and the HRA. And that's why best practice timeline is you want to be getting this process done early. You don't want to be starting it after year end. You want to start it before year end so you can get, if need be, that first 10% increase. And then by the time you have your AGM, which is only already due by the end of the 4th month of the year, then you can get the rest of it topped up, the rest of that increase. 4th month, body corporates, and 6 months for homeowners associations. So that's my advice and my tips with trying to get through a smooth budgeting process. Okay, so the next section I want to talk about is financial reporting. So very important. I mean, there's a few items. I'm going to show you specific financial reports and what they look like, more common financial reports. Now, the idea of a financial report itself can be almost anything. Anything that it's financially can affect the body corporate or the HOA. But there are specific formal reports that are more structured, that are very common and are very useful. They get sent out monthly, and they've got the annual financial statements, which are more formal. And this is your balance sheet, income statement, cash flow, and which I'm going to go through. If I can just go on the next slide, please. So financial reporting, what do we want financial reporting? Why is it important? So a financial report is a report that actually gives you the stakeholder. The stakeholder is anyone who's actually derives interest in the report that you're given. So that actually means that has an interest or vested in some sort of angle of the body corporate of the HOA. And you want to give them a financial report that accurately reflects different aspects of the financial situation of the HOA body corporate. And this will include your revenues, this will include your profits, your cash, and that's why there's processes in place so that ultimately you get the report that's accurate, that's timely, that you can get consistently, and that you can make decisions off. So good characteristics of financial reporting, they have to be understandable for anyone that uses it, understandability. So you can actually see what you're looking at. It's all very well getting a complicated document, but not that has every information, but you can't actually read and understand it. You have to be relevant and reliable to where you're at, that you know the information is relevant, it's based on your needs, has to be objective. The nice thing with finances is that it's not a subjective matter. This is the number, this is what it is. So it needs to be objective. So you can't make a decision, okay, if we that puts more on a personal basis on it, this is what the number actually is. It has to be consistent and comparable. You have to be able to compare it. And the reason why you need all of these different traits, timeliness, that you get it on time, that you don't get it 3 years later, then actually is irrelevant of the information. Transparency, you want to see all the information, you want to see what's happening from the report. And very important to depict a true and accurate financial position. So your financial position is where you're at. These characteristics are really important in financial reports, and any type of financial report needs to have this. So I'm going to start with the first type of common financial report, and this is called a balance sheet. People know it as a balance sheet. It's a very common report. It's got other names called statement of financial position. And what this actually does is this represents to everyone all the assets of the entity. So this is all your vehicles, your properties, your debtors, your receivables. It shows you all your liabilities, which all your obligations. A liability is an obligation. A good example is a supplier that's owing, a loan amount that's owing, and then ultimately equity. Equity is what is the net value of the business. So if your equity position is a positive, is showing your assets greater than your liabilities, then you actually got a strong financial position. So as you can see from the screen, this is a good layout of a balance sheet. At the top, we have assets, and it shows non-current assets. Non-current assets means the assets that are longer in lifespan. So let's call it a property, a building that takes a long time. That's got a long lifespan. Current assets are assets that get realized within the next year. So they're more liquid in nature. So cash, for instance, cash can be turned over, but it's more of a current asset, what you got now that you can pay for things. It shows your total assets. That side, everything with a balance sheet, the reason it's called a balance sheet is because it needs to balance. So you have your assets on one side, and on the other side, you have your equity and liabilities. And as you can see here, your total assets and your total equity and reserves and liabilities, they both agree to each other, and that's why it's called a balance sheet. So it's showing you where it's at. If you have a situation where your liabilities alone exceed your assets, then we've got an insolvency issue. But in this case, if you were to take your assets less your liabilities, you can see that your equity is actually okay. That's just the basics of accounting. There's two sides to it. Your balance sheet shows your financial position. Very, very important financial report. Then comes your income statement. Now, your income statement shows your profit and loss for the period. This shows your income, shows your expenses, and ultimately shows you if you're making a profit or loss. And this is very good for performance. This is showing you how you're doing. And if a business is doing well, you're going to have a profit, and people are very happy when there's profits. And this is just what the income statement's about. The next report is your cash flow statement. So now a cash flow statement for me is a very, very important document. So what's nice about, so if I compare it to the other reports I'm telling you about, an income statement itself shows you incomes and expenses, all your incomes, all your expenses, so all your levies and all your stationery, gives you all your levies more than what you expend, that's a profit. It doesn't necessarily represent cash, because accounting doesn't necessarily represent cash. So let's say, for instance, you build all your debtors, all your debtors, let's say it's R1 million, and only 100,000 of actually money you receive from that R1 million, your income statement is going to show you the R1 million. However, your cash flow statement is actually going to show your actual cash position. So for businesses to stay afloat, a cash flow statement is very important. And that's actually going to tell you what's happening with your cash flow. So it's a historical report. All of these reports I've shown you are historical. They've all happened. So you're not forecasting in the future. It's everything that's happened is actual numbers. So cash flow statement is usually divided between operating activities. In this case, it'll be the functioning of the body corporate and the HOA. Investing activities. Have you invested in your money into another bank account or some investment or assets, things like that, bought property, and financing activities. And that's going to be, have you taken out loans and have you paid it out? So just giving you three main ideas, cash flow streams that happen in any entity. So very important documents, and you'll see from it, it shows you your opening balance, your closing balance, and your movement for the period. Now, all of that's great. That's all your historical financial reporting. I was talking generally what is financial reporting. You can be reporting on anything. And Andrew, at the beginning of his introduction, alluded to financial management. Now, financial management doesn't just involve reporting on historical amounts. We spoke about budgets. What is budgeting? Budget is planning in the future. So I'm not telling you about something called a cash flow forecast. And the best way to look at it is, let's look at our own personal situations. If you were to look at your bank account, and let's say you wanted to buy a car, or you wanted to purchase like a car, a motorbike, or something expensive in the future, what would you ideally do? You'd look at your bank account, you try to forecast what is your expenses every month. Okay, I've got telephone and I've got water, electricity. You're going to forecast, factor that in. Okay, do I get money in? Yes, I get a salary. You're going to factor that in. And then you're going to see when would you be able to buy that motor car or that motorbike, etc. So cash flow forecasting itself is also a very good and extremely useful type of financial reporting. Okay, and some places require it more than others. When the body corporate or the HOA is a bit more distressed, you're actually going to do a bit more cash flow forecasting, because you have to see what is your bank balancing going to be. Ultimately, if you don't have money, you can't pay for something. So it's very important to represent your bank account in the future. You're going to, just like a budget you're planning, yeah, you're planning cash-wise. So it's cash flow forecasting. I thought I'd just show you, as an example of it is, you'll see on this document, you'll see there's 3 columns of actuals, and then it gets forecasted for the next 3 months. So you can forecast for a month, for a week, for 6 months, for 12 months. It's a very good financial reporting tool, and it can work. This has got a lot of colors, but there's no set and specific structure to cash flow forecast. The income statement and balance sheet are more set and structured. You'll see them looking pretty much the same. But a cash flow forecast, ultimately, you're deriving a way of identifying what is your balance going to be in the future. When are you going to be short of money? And also maybe you have excess money that you can actually invest to earn more money on. So that's what I'm talking about cash flow forecasting. Okay, so all of us together, what we do is monthly we have a chairman's pack that we send out. And remember, one of the characteristics I spoke about of financial reporting is that you want relevance and you want timely reporting. You don't want something that's going to be a year late. And part of the whole process is a chairman's pack report, which is a monthly report of the financial positions. Now, this is a report. I've gone through a few financial reports. In our chairman's pack report, the whole idea is to give out accurate, timely information to the trustees. And I'm not sure how many of you caretakers also get this, because I know there's quite a big distribution on certain estates. But the whole idea is to understand where we're at, with all our different aspects of our financial report. And what we do is our Chairman's Pack report, it usually gets circulated between the 15th and 20th of the month. So let's say for this month, we're going to be reporting, or the August, at the end of August, the August report should have been sent by the 15th to 20th of September. But in the report, you have the balance sheet, which I've explained to you, talks about all your assets and liabilities, and tells you whether you've got a financial, a solvency position. Then you've got your income statement. And your income statement, there's two sections, your admin fund and reserve fund. So it's your day-to-day, saying, hey, day-to-day, are we making profit? And your reserve fund, same type of idea. Are the levies we're collecting more than our expenses? Then we've got an arrears report. And this is just a report talking about our arrears. Remember the example I told you about whether we've raised R1 million worth of debtors and only collected 100,000. This is the report that's going to tell us who's actually owing. There can be a payroll report in some of them. Salaries can be a very big expenditure. You've got a trust account disbursement statement, which is effectively your cash account. You've got a creditors roll, which is talking about all your suppliers that you pay, and your municipal accounts. So we'd send out monthly municipal recons. And this is all aligned. Remember, I spoke about important and relevant information. Municipals are one of our biggest expenditures. So we're looking at what happens if we've been estimated for a few months. We didn't even realize it. Next thing you get a big bill. This is where the recons and these reports come in. So part of our practice is we're sending this out so there can be good financial reporting that will allow for good financial management.
Thanks, Dave. Before we move on to the petty cash topic, can I ask any of the panelists if they'd like to add any practical tips or comment on what you've presented on? Is there anyone who would like to make any comments? I've got a few. All right, just a few points I'd like to mention is, many of our caretakers, many caretakers do attend the trustee meetings, and they would have come across the presentation of these financial reports at the trustee meetings and worked through the reports with the trustees. As Trafalgar, we always recommend that a financial trustee is appointed, and the financial trustee would ideally have financial management experience, not necessarily being an accountant or a bookkeeper, but somebody that's familiar with the reports, that's familiar with financial management, and actually takes an interest in reviewing these packs. It's really important for actually all trustees, but particularly the financial trustee, to allocate some time each and every month to work through this list of reports very methodically, because this is the monthly dashboard. These are the measures by which the financial well-being of the body corporate or the complex are going to be evaluated. So by working through these reports, it's possible to see, are we on track in terms of what the budget forecast for expenses? Are our levies sufficient to cover the costs and the costs that are forecast? Are there any variances between our actual expenses and what our budgeted expenses are, and why are those expenses different? So has something changed? Is there new information? Is it correct that the expenses are greater than budgeted? Because if there are variances with expenses, it could put pressure on the levy income to meet the building's expenses. So that's really important, to identify variances or unexpected differences, and then to make sure that they are correct or that they are managed. And ideally, they should be matched to the budget, because remember, the levy income has been matched onto what the forecast expenses were. So that's really important. So just allocating somebody to be responsible, that person spending the time to work through the report, is a big step forward. If there are any queries on any of these reports, it's really important that queries are referred back to the portfolio manager. They're the contact person in terms of the property management. They may ask assistance from the Trafalgar accountant, and we have teams of accountants that are responsible for putting these reports together, for checking the reports before they distribute it to all the trustees. Also remember that any owner in a sectional title building is entitled to inspect the financial records. So we would send the very same report to any owner who inquired about these reports. And very often estate agents ask for these reports as well, because somebody looking to buy into a sectional title building or a homeowners association building would want to see these reports to judge how, how the finances of the building are performing and the well-being of that building. So, these reports are used by a number of different stakeholders, as David called them, not only owners, but prospective owners as well. We also need to report to banks, because the banks will ask once a year for financial reports, typically the audited financial statements, and they use these financial reports with the same information to judge whether they are comfortable to grant bonds in these buildings, and that the risk they're taking to lend to owners buying units in the building is a safe one. So the banks also use these, and it's really important, therefore, that the information, like David said, is accurate, it's complete, it is representative, and that buyers, banks, owners can make correct and valid decisions from the information that is reported here. So I'd like to emphasize that as well. Maybe one or two other practical points just to be aware of. Municipal accounts typically represent about half of a building's expenses. So 50% of a building's expenses are typically the municipal costs: water, electricity, refuse, sewer, sometimes gas if there's gas in the building, but certainly a very significant cost item for a building. Now, because of that, it's important to make sure that those costs are correct. I think you will have all come across cases where the municipality estimates the meter readings. They judge the costs on estimates. Those estimates can go on for many months. And because the meter readings are estimates, the costs are not necessarily accurate. And many of you as caretakers may have been asked to check the municipal meter reading, or to send through an actual meter reading, so that can be sent through to council, so the bill can be corrected with an actual meter reading. So that's really one important point to make. And the other is that we need to measure the recoveries of the municipal charges. So what water and what electricity costs are being recovered from the residents to contribute to these municipal charges, to make sure that owners are actually paying for their own consumption, and that the levies are not subsidizing consumption inside the section. And we measure a recovery percentage of the recovered electricity compared to the municipal charge of electricity. And that recovery percentage should ideally be over 90%, meaning that 90% of the costs are recovered directly from the owners as their consumption inside their sections, inside their units, and therefore the levies are only really supposed to pay for the common property areas, the corridors, the carports, the reception, the grounds, etc. Only those common areas should be covered by the building specifically and the levy income, because the rest is recovered. So it's really important to keep a close eye on that recovery percentage and to make sure that it's being well managed. If there's a gap, that gap below 90% should be investigated, and there should be measures put in place to try and close that gap. On the creditor's roll, we need to make sure that there's no outstanding balances due to the creditors. So the creditor's roll will show you which creditors have been paid, which service providers. It's important for caretakers and trustees to see that they agree that the costs that have been paid are correct, that they're aware of those costs, and important to see that there are no outstanding balances which you would not be aware of, because an outstanding balance could be a problem in terms of further services from that creditor, or it could be incomplete jobs, or it could be an accounting issue. So that needs to be checked as well. In the trust account disbursement statement, this is normally the first report that the financial trustee will keep a close eye on, because that's the bank balances. That is the money sitting in the bank accounts which is available, and obviously that's going to be crucial for paying municipal charges, paying other service providers, and making sure that the building can meet its month-to-month obligations. On the payroll report, we often have difficulties with leave balances. So that's one of the main reasons that we want to include this report, so that trustees and caretakers can see what leave is recorded for all the building staff. Is that leave balance correct? And very often we see that leave forms, are not sent through they're not captured on the payroll system, and these leave balances become out of date. So important to keep an eye on that. And many of you will be asked to confirm leave balances or to look into missing leave forms to make sure that those leave balances can be corrected. As I said, next week we're going to look at levy arrears and the process to collect levy arrears, because debt collection is an important property management service as well as critical for the for the viability of a building. So we'll talk about that next week in more detail, but certainly there's a very active role which caretakers can play in collecting arrears. So I think those are just some practical tips to point out, but certainly there are accounting teams at Trafalgar that are preparing these and checking these and making sure that they go out in time. But it's so important that time is spent by trustees, possibly by caretakers, to review these reports, make sure you're comfortable, make sure that you are well aware of what's being reported, that you're spotting variances, that you understand and confirm those variances. And if there are any queries, those must be followed up either with the accountant, the portfolio manager, the service provider concerned and resolved, because if those variances continue, they can stress the levy income to match those expenses. So I think there we go. Let me just see. I think Dave will hand over to you. We've got some questions that have come in, but we'll get to those questions at the end of the petty cash topic, and I'll have a chance to work through them then. So over to you to continue.
Okay, thanks, Andrew. Okay, so the next section now, and while we specifically want to talk about petty cash itself is actually, obviously anything involved with cash is more of a high risk area. And in case some places don't have petty cash, the old fashioned petty cash was actually having a small tin with a set amount of money, and what that tin and that money was used for was generally small sundry type of expenditures, so small office consumables, whether it's stationery, whether it's maybe toiletry items or things like that around actually the office, sugar, tea, coffee, just small sundry refreshments, urgent stuff that, it's more of a hassle to try pay via EFT and you needed something urgent. That was the idea of petty cash. A more modern version of petty cash, which is the same thing, is having a pay card or a debit card with the same exact type of funds available. So usually a petty cash, how it will work is you actually have a set limit that you need to spend, or not need to spend, that you have available to spend, a set amount of cash. So let's say your petty cash tin has 3,000 Rand. Every time, every expenditure that's made with out of the petty cash needs to have a supporting slip. So if you went to the shops and you bought coffee for 100 Rand, what you'll then need to do is provide the supporting slip for the 100 Rand, and then a request will be made to top up the petty cash, because now it's 100 Rand short. The 3,000 Rand is no longer 100 Rand, to get it back up to 3,000 Rand. The same idea can work now with a pay card and a debit card, where you have that already in the bank, almost like 3,000 Rand in your bank accounts from this card that you can use to spend. This type of system is called an impress system. And the big risk with this, obviously, you're dealing with cash, can be unauthorized items. We speak about financial reporting and financial management. The items could not be included in financial reports. You actually don't have a true reflection of what's happening in your financial reports. People can be misusing petty cash and start buying their own personal groceries and things like that. So that's why it's very important that there's sound petty cash management that's in place. And to do that, I've just put a few tips to help with petty cash management. Okay, and the first thing you actually need to do is you actually need to establish what is the amount of petty cash that you're willing to have on hand. And this will come from discussions maybe with yourselves and the trustees that you put together. This is what the formal policy is. We can have a petty cash tin that's 2,000 Rand. It's very important to have this. And then you have one person that actually looks after that tin and has it in a secure place. So the first thing is you've got to make sure what is that amount, because otherwise you can start having petty cash tins of 20,000 Rand, and that starts like getting away from the purpose of why you have petty cash. The next thing is there needs to be a petty cash policy in place. So a written petty cash policy of what is the balance, who takes control of it, who's accountable for it, what can you use to spend the petty cash on, because then again you can start using that spend for almost anything. And it has to be within the bounds of petty cash. So it's important to have this in place. Then every transaction, petty cash should be logged in a transaction logbook or we call it a petty cash book, should have its own accounting, GL account and records where every transaction has been logged, has been reconciled, has a supporting slip. It describes what has been spent for and the date, etc. And you need one of those to help manage the process. You should have one staff who's designated, only one designated staff member who's accountable for petty cash. This brings in the whole accountability and it gives that person that responsibility. And if anything goes wrong, then you can trace it to where is that. It needs to be kept. If you're doing the cash method, if I can put it that way, of petty cash, that tin needs to be kept in a secure, safe place that only one person has access to it, and maybe the backup is maybe with someone off-site or even here at Trafalgar, that if there is a backup key for where it is, it's not easy to get hold of. Petty cash itself, every month, you should have a process of counting your petty cash. So expenses happen. A request for cash from the petty cash will happen throughout the month. This should be noted in a petty cash receipts book. And then every month, the petty cash itself should be counted and then compared to a logbook. So if you physically count, you've got 2,500 Rand in your tin, you should have a logbook with all the transactions that tells you that there's 2,500 Rand. And again, all petty cash, all the expenditures need to have supporting documents. They need to be tracked. And there has to be one person who's the custodian of petty cash. These are my tips for it because it's so easy. You can have a tin, you're putting it on your desk, you suddenly go out because there's a homeowner asking a question. Next thing, someone comes in without you knowing, and it's so easy to take funds out of the petty cash. It's a very high risk of theft that it's important that we have safe and secure methods and management regarding petty cash.
All right, thanks very much, Dave. I've had a question in terms of the confidentiality of some of these financial reports and who would validly be able to have access to them. So I don't know if you'd like to just address that, Dave, in terms of, what allows us to provide this financial information to owners, to banks, to estate agents, and to, other stakeholders as well, like SARS, for instance.
Okay, so obviously it depends on the structure of call it, whether it's a body corporate or an HOA. So body corporate themselves, sectional title is governed by the Act. And the Sectional Title Act says that people can have access to the financial information on request. So your monthly financial information and your annual financial statements. So usually what happens in practice is this is governed by your trustees unless someone really asks for it. It doesn't get circulated that often. Also, depending on the nature of the body corporate, some people might put a summary page or in a newsletter and send through financial information. An HOA themselves, they could be governed by the Constitution, and that will determine of who can actually have access. I've seen places where it's not allowed to be circulated to all the members. So it all actually just depends. But then there's other places that everyone can have access to it, but it's not freely circulated. You actually have to request it. So confidentiality, technically every homeowner in a sectional title or HOA is a member. They pay levies to contribute to the well-being. And this is also where the form of an AGM comes in, because that's where your formal meeting that's transparent of where we're at with the financial reports. You get your financial statements approved and signed, formally approved at the AGMs, because this is how it's governed per the Act. So everyone can have access to it, the financial statements.
There's a question here about a caretaker using their own personal cash resources for building expenses, and then they're only refunded when they submit the necessary slips. So I've said, Dave, do you agree that it's not ideal for anybody to use their own personal money for building expenses, because that would be inconvenient, unfair, it might have own, cash flow implications for the person concerned. So it'd be much better to run a petty cash system. And it's also possible to get a pay card where there's a sort of debit card for the building, and the debit card could then be used for building expenses. And obviously the slips are required as well for accounting records, or the invoices could be photographed and sent through on WhatsApp to collate the necessary records in that way. So can you confirm that, Dave?
I completely agree, Andrew. It's not ideal for any employee caretaker to be paying out of their own pockets. And if that is a situation that happens, I think it's always important to discuss that process with the chairman or finance director or trustee beforehand, because you don't want to, it's a nice gesture, maybe it's a process in place, but ultimately it becomes a bit almost unfair if you take so long for you to be reimbursed out of it. A petty cash is designed that way as well, so it can alleviate those stresses on the employees.
Dave, then Nico would like to know, what is the legal standing on an IOU note in the petty cash tin? So does that make sense? So if somebody, instead of refunding the petty cash, they put in an IOU chit to say, right, well, they will refund the petty cash.
As far as I'm aware, to be honest, IOUs don't have much legal standing.
Okay, so that wouldn't be ideal at all.
Yeah, you'd rather have a letter, almost like an acknowledgement of debt, even if it's an informal one, saying, I, David, took this money and owe you this amount, and you have the caretaker signing it with someone else signing it. That is a lot better than an IOU.
Yeah. All right. So, I mean, petty cash is a really important point. I'm getting quite a few questions are coming through on this. So on the one hand, we need to balance convenience for the caretakers to have the money they need to buy supplies, to buy consumables, and to get things quickly and easily and to be able to do their work at the building. So that convenience and speed is really important. But matched to that, we need to make sure that the financial records for the building are complete and they're up to date, and that they don't cause a complication with the annual audit and the financial reporting. So to make sure that the financial records are complete, that they can be completed accurately, and that the audit file will be complete as well, each and every expense, even if it's through the petty cash, does need to be justified by an invoice or a photograph of an invoice, which will then show how those funds were expensed and to whom they were paid. So, therein lies the challenge. And we've got Zingapi Martin is saying that, in their experience, the petty cash is a challenge to make sure that the financial records are complete and are maintained accurately, and that they prefer a pay card. So a pay card, which is a special debit card for a building, is available. Trafalgar can organize that. They certainly do work well. Most of you will use debit cards, so you'll be familiar how it works. So it can be done. But the other option is that many suppliers deliver. So many of the annual consumables that are required by a building, whether it's cleaning materials, whether it's chemicals for pools, paint, whatever the case might be, all of that can typically be ordered for monthly delivery or even delivery as required with a few days notice. And, in that way, the materials are delivered. There's no time taken to go and purchase them, to source them. Typically, an account can be arranged with a supplier. It takes care of the financial records. And having accounts and deliveries is another way around this particular problem. So I'd actually suggest that, as far as possible, that would be a preferred approach, and certainly can bypass a lot of the practical challenges that are coming up. All right, so I'm going to just pause there. I've got one or two more, but I just need to read them before I can refer them. So Sadhna, I think I'm going to just hand over to you, if you wouldn't mind then carrying on with the next topic, so the creditor invoice payments.
Sure, thanks Andrew. Good afternoon everyone, thanks for joining us. The topics that I'm going to be covering this afternoon, firstly just to touch on our paperless environment, creating of a new creditor and change in banking details, and then our invoice process, and thereafter we'll take you to the validations. So firstly, just to start off by saying that 90% of our work is done in a paperless environment. And Trafalgar strives to reduce their carbon footprint And in doing so, our systems are integrated database, the document management system, which enables our staff to work electronically and remotely with ease. So yes, we do get physical invoices coming through, but more often than not, it's electronic. The next 3 slides is actually the process overview of creating a new creditor onto our system. So once we receive an invoice, we first have to establish if we do have them loaded or not. If they're not loaded onto the system, we do follow a process to get them loaded onto the system. We do verifications, which is on the Standard Bank platform on all our creditors that are loaded on the system. Thereafter, once that is a successful verification, we go on to load the creditor. If that verification returns unsuccessful, we thereafter contact the supplier to provide us with further supporting documentation. And only once we are satisfied with that information, thereafter we proceed to load that creditor onto the system. That's the loading of new creditor process. Then we also have an instance where we already have a creditor on the system, but their banking details have changed. And of recent, we found a number of incidences, and this is a potential fraudulent area. So Trafalgar has taken the stance now to contact all of our creditors who have changed banking details, and we phone them, we get their details of their invoices or the internet, and we actually call someone quite high up in the company to decipher firstly if they have changed the banking details, and then we do confirm with them the correct details before changing it on the system. Then the invoice process, just as an overview, from start to finish, once we receive an invoice, we don't simply just pay it. It goes through a procedure and a process in our office. And it starts off by the invoice being captured by our portfolio administrators. It's indexed onto a system called Caretakers, which is our document management system. A PA review, there's mandatory fields which needs to be completed and then sent to a PM. The PM checks these and approves once they're happy. It's then forwarded to the creditors clerk who processes the invoice. He or she would then forward it to our RFMs or RFM assistants who does a batch validation process. And if all is well, then we proceed to do the payment. In an instance where any of the information was not correct at any point, if there were information that was missing or something captured incorrectly, that then needs to go back right to the beginning, and it goes back to the PA, and we need to start this process all over again. So we do try our best to adopt a first-time right approach, and if we do identify that something is captured incorrectly, we may need to contact the client again. Also, with loading of new creditors process, just to let you know that when we do receive a new invoice for a new creditor, it does take us around 48 hours, or up to 48 hours to do the verification and load you on the system. So if a creditor comes through with an invoice today, it's not necessary that we'll be able to pay you guys tomorrow, because there is a whole process that we have to follow before we can actually make payment. That's just a process overview from start to end. If anything, as I said, is incorrect, then we have to go through the entire process again. The next few slides we're going to take you through covers the following topics. What is a valid tax invoice? What is it? What we require? What we receive? A checklist. What's an invalid tax invoice? Some things that we consider. Approval types. Payment process, our internal process that is, and then a guidelines on our batch validation process, which we do internally as well. So how do we help each other to ensure that the invoice we receive is good enough to be paid? Receive an invoice from any contractor, supplier, etc. These invoices are valid tax invoices. So when we say valid tax invoice, what is a valid tax invoice? So for it to be a valid tax invoice, it needs to contain the words tax invoice, VAT invoice, or invoice. It must depict the supplier name, address, VAT registration number if VAT is being charged. The recipient's name, very important. It must have body corporate or homeowners association, Care of Trafalgar, and it should not be addressed to Trafalgar. Care of Trafalgar is fine. Even if it's just a body corporate name without Care of Trafalgar, it's fine. But invoices made out to Trafalgar puts us liable for that payment when it is actually the body corporate who is liable for that payment, or HOA. If a building is registered for VAT, then the registration number must also appear on the invoice. Address, we require ideally a building address, or alternatively Trafalgar's address. Invoice number, it's actually a very important one on our side because we actually use the invoice number when loading this onto our QDoc system. Date of invoice, accurate description of goods or services, the quantity or volume of the goods or services supplied. Then we check for totals, subtotals, VAT, and we recalculate, especially on the handwritten invoices because there are errors that are noted. Pro forma invoices are allowed on exceptional circumstances, and we'll discuss this further below. And then banking details of the supplier, if it's available. Not all invoices come with banking details, and that's acceptable. We normally have the creditor loaded, and it's just nice to have banking details so we can double check against what we have on the system. And then lastly, we check for all payments to have trustee and director approvals. So actually, what we want to see when we receive an invoice, just the next slide, please, Andrew. Okay, so what we require, this is an actual example of a perfect invoice for us. It says tax invoice, it's got the date, it's addressed to the building, it's got the supplier's details, a VAT number, it says quantity, got the description, the amounts, and then VAT. And then what we also, what we receive sometimes in our office is the next example in the next slide. And this looks like it was a very pretty invoice, but it generally, these types of invoices are quite busy and they can be filled with information that has less relevance or sometimes no information at all in what we can use. So now that we've spoken about that valid tax invoice, many will ask, is this a Trafalgar requirement? And the answer is no. On the right-hand side, we have a checklist that we've put on here, and this checklist is actually from the SARS website. So these requirements are from SARS. There's a full tax invoice and for an abridged tax invoice as well. It's their requirements. This again here is a perfect example of a valid tax invoice. The next example I want to take you through is an invalid tax invoice. And why is it invalid? If you just look at this invoice, it's something that we created for our in-house training. You'll note that it's made out of Trafalgar Properties and it's not the client, not Care of Trafalgar. There's no address depicted for the body corporate. There's a word quote on it. There's no VAT number indicated, although VAT is being charged. It's very vague details as to what work was performed. There's no date on the invoice, and then there's no banking details. So yes, banking details is not a requirement, but it's preferred. So we do prefer for you to have that on the invoice. If it's not a problem.
So Sadhana, why is this so important? So what happens if invalid invoices are processed? What is the risk and what is the potential comeback to the builder?
Sorry, Andrew, invalid tax invoice.
Yeah, so I mean, why do we take so much time to check that the invoices are correct, are complete, are accurate, and are configured in terms of these SARS guidelines that you referred to on the screen now? So
it's for the same reason. So if SARS requests for those invoices, they need to be aligned in regard to that checklist that we have discussed. And those are exactly what we look for during the batch validation process as well. And it's very important that you have those items, otherwise SARS will reject those payments on their side.
Okay, so maybe just to add to that then is that, you know, if SARS rejects the invoices and rejects the costs, it will inflate the taxable income for the building, which could lead to increased tax liabilities, and it could lead to penalties and interest as well.
Yes.
So another way of saying that is that only with correct and complete tax invoices, as San has explained, will the will there not be an issue with tax in terms of a comeback from SARS and potential tax liability? So that's really important. And also, these very same invoices are included in the annual audit file, and the auditors are looking at these invoices as well to compile the annual audited financial statements. And if they are finding inaccuracies or incompleteness in the invoices, there's going to be a problem with the annual audit. And that could lead to taking longer to get the invoices corrected. And if the audit takes longer, it could cost more. It can certainly delay the audit, and it can delay the annual general meeting, and it causes, ripple effects from there. So those are some of the important and some of the practical issues that arise if tax invoices are not correct up front. And as I always say, there's no time like the first time to get it right. So first time right is essential, and most certainly the service providers are most motivated to get correct invoices through to be paid promptly. So we cannot pay on incorrect invoices, because if we do, there's risk, as I've explained, and the best time to get it right is before the contract is paid, so that they will come back to us promptly with corrections if necessary. So please do bear those practical issues in mind. Right, there we go.
Okay, so some of the things to consider and what we've discussed already. We need to ensure that there's valid invoice, valid date and invoice number. The building name is valid and addressed correctly. We want to ensure that the creditor supplier name is valid and addressed correctly. Amount paid, ensure that the totals are correct and according to the quantity. If VAT is charged on an invoice, the VAT registration must be on the invoice. If the building is a VAT vendor, and if so, the building number the VAT number must be on the invoice as well. Is there valid stakeholder approval? And then are there sufficient supporting documents? Example, till slip, invoices, emails, ID copies, etc. These are for reimbursements. So we did speak about approvals, and you may ask, what is a valid stakeholder approval? So there's many types of approvals that we do get. And we mean, when someone says, please pay the attached, it's an example of a vague approval, and we receive quite a number of those. So when we do receive approvals for invoices, we like them to be precise and to the point, and also so that that particular approval cannot be used for multiple invoices. So the approval must be specific to an invoice. There are a lot of instances whereby we do receive signed invoices, and often it's just a squiggle on an invoice. It's very hard to decipher who actually signed the invoice. If it was a trustee, if it was a caretaker, we're unsure who actually signed the invoice. So it's extremely important for those invoices to accompany, and it has to have a name and a date. And for contractual services, then we need to ensure that the service provider in place and that there's a resolution signed by the directors or trustees authorizing the monthly payments. That's in the recurring payments resolution. Then we do have signed minutes as well that can be used for approval of payments, provided they fall within the relevant financial period and has been signed and approved by the trustees and directors. Email approval is actually the most common for Trafalgar, and it's the one we look at all the time. We do have a Trafalgar standard email that's built into our document management system, and it actually is a perfect example of an email approval. It's got the invoice number, it's got a job number, it's got the amount, it's got everything that we require. So there's no, it can't be seen as a vague approval. If you are approving that email, all the details are on the subject line itself. And then we do get other standard emails. So if we do receive an email, sometimes it could be vague, but we do then request from the trustees to advise us if they are really approving that or not. Then with it, just to take it a step back, sorry, Andrew, the last approval is actually WhatsApp approvals. So Trafalgar is also moving with technology and the changing times, and of recent, we have seen a lot of WhatsApp approvals. We are still finding our feet with it, but as long as it has all the relevant information, our PMs are generally dealing with the trustees and they have them on WhatsApp, and invoices are getting approved via WhatsApp as well. So as long as you got the date and the invoice number and the amount, and you're approving a specific invoice and all the details are on the actual chat and it's screenshotted and it's indexed on our system for payment, we accept that. That's covering the approvals.
Okay, Sadhna, can I just add a few comments? There was a question on recurring payments.
Sure.
And I'll just go into a little bit more detail. So we think, or let me say, I think that at least 80%, and some people say 90% of building costs are recurring. That means that each and every month there's the same or a similar payment that needs to be made. So it's recurring. Often recurring payments will be backed by a service level agreement, and examples would be security, a cleaning service, a gardening service, a pool cleaning service. Even annual costs can be recurring. For example, the annual radio license fee for armed response. Now, the reason that it's important is that it significantly saves time to group recurring payments into what we call a recurring payment. We've got a recurring payment work stream or workflow, which deals with these separately. So how that works is we ask the trustees to sign a schedule, which we call a recurring payment resolution. We list each and every payment, the service provider's name, the cost, and that's put in a schedule which the trustees approve by way of signature and a recurring payment resolution. We can use that same document each and every month to pay that schedule of costs without asking them for approval again and again each and every month. That saves them time, it saves them volume of emails, it allows the payments to be made more quickly, and on the accounting system, the previous month batch can be recalled. We can make any small changes because the payment resolution allows for minor changes. For example, if there's an overtime for security for a public holiday, there could be a small change in that cost. And then we make the payment based on this resolution as the payment approval, as Sadhna was said. So it's really important to try and group as many costs as are reasonably possible into a recurring payment batch to get them all approved with one resolution. That means that the bulk of payments can then be paid without asking the trustees for approval individually each and every month. It saves them a lot of time, which a lot of them are very anxious to save time. And as I said, the whole process flows a lot smoother. So we do find many buildings that don't have these recurring payments, or they have many recurring payments which are not included. And, you know, it would be a strong suggestion to try and get that in place because it really does save a whole lot of time. So that's just an important sort of point to emphasize as well. So then I'll let you carry on. I've got some more practical points to raise off.
Okay, sure. Thank you, Andrew, for that. The recurrings are very important, and yes, Trafalgar is moving towards the recurring process. So we're trying to get as much payments. It's a much more efficient way of doing payments. Then our internal process that follows. So once we've received all the documentation and the invoices, what do we do with these invoices? Well, our trust creditors clerk is responsible in our offices for payment of these invoices. The cutoff time is 9:30, and that's for whatever invoices she receives by that time is allocated for payment of that day. And then the trust creditors clerk then prepares and reviews all the invoices she receives and starts a payment process on our system. So prior to capturing, these invoices go through the batch validation process, which is first checked by the trust creditors clerk and then the RFM, which is our regional financial managers or the regional financial manager's assistant. And errors are checked for as per the batch validation guidelines. The creditors clerks now go through each invoice on QDocs and validate this information indexed against the invoice and the approval received. And those that don't meet the criteria are sent back to the relevant staff to correct. They will then obviously correct those information and send it through for payment. So we did mention batch validation, and we call it batch validation because we validate these invoices in batches and quite in a large number as well. So what do we look for in an invoice. It's the same things that I just took you through, but we can recap again. These are just guidelines for what we look for in an invoice. And it's just to help you, so when you do receive an invoice, you're aware, you can say, okay, this is not a tax invoice, so Trafalgar is not going to accept it. Please can you issue us with a tax invoice? Then just to note again, supplier name and address, VAT registration number, a recipient's name, very important. If the building is registered for VAT, then the VAT registration number must appear in the invoice. Address, invoice number, date of invoice, description of goods, quantity, pro forma invoice or quote. So I don't think we've touched on the quote aspect. We're not allowed to pay on quotes. We only pay on invoices, and in some instances of a pro forma invoice where we are unable to get an actual invoices. There are instances when you're purchasing raw materials, etc., from a hardware store, and payment is expected before an invoices, and these suppliers tend to then only give us pro forma invoices. So once on the quote, a quote can be attached to the supporting documentation, but we will not be allowed to pay on the quote itself. If an invoice says, the description on the invoice says as per quote, then that quote can be attached to that invoice and submitted through for payment. So wait states as work done as per quote, that's what I was talking about. Then supply details are preferred on the invoice, but it's not necessarily there all the time. And then to remember that all payments to have appropriate trustee and director approvals. And then we check for the calculations, we recalculate on those invoices as well. So is there any questions? Because I think I'm at the end of my presentation.
So I know there have been a number which I've been answering as we go, and maybe you can just talk to this one. Can a quotation be regarded as a contract, or let's say an approved quotation?
An approved quotation as a contract?
Yes.
It depends who would have approved those contracts. If the trustees have approved the actual quote, then I would think it can be used.
All right. Very good. Just some practical points from my side. The first is that I personally get very frustrated when service providers expect payments immediately or the very next day. And it's really important that expectations are managed quite clearly up front and that everyone's aware of what to expect. Now, I don't know how many of you know, but the likes of Pick and Pay and ShopRite pay their suppliers on 90 days, 3 months later, 3 months after getting to, services or goods delivered. That's typically the turnaround time of those large retailers. Government entities are paying over 6 months later. I would consider 30 days as a reasonable turnaround time for a creditor payment, and most businesses work on 30 days. So I really got no idea where immediate payment expectations come from. That doesn't mean that we are trying to pay on 30 or 60 or 90 days or longer. We obviously are trying to pay as fast as possible because it helps the flow of the financial management. It helps the financial reports to be as accurate as possible. And we're obviously aware that the service providers benefit from regular and consistent cash flow. So Trafalgar is actually making payments as soon as we practically can, once all the documentation is in place, once the documentation is correct, and once it's been fully checked. So the flow continues on a day-to-day basis as the necessary dependencies are covered, and we've got 3 separate checking points in terms of making sure that the invoices are correct, that the approvals are correctly in place, that the values have been correctly captured on the accounting system, and that the payment is then made as soon as possible. And I would have thought that payments are made within 3 to 5 days. If the documentation, the invoice is correct, it's submitted to the portfolio team correctly, the invoice is accurate and complete with the details Sardner explained, and the approval is correctly in place, either with the trustee approval by email or signing on the invoice or through a recurring resolution. So I would say 3 to 5 days is a reasonable expectation. Now that timing changes if it's a brand new creditor that's not loaded on our system, there's some extra validation steps which need to be taken, as in confirming the bank account details of that new service provider. So that does take a bit longer because there's a separate system that needs to be used to check that the bank account is valid and correct, and that it's correctly matched to the creditor as per the details on their invoice. So that bank validation is an important first step, and only after that can the creditor be loaded onto Trafalgar's system, and only after that can the payment process start. So if it is a new creditor with a new take on of the creditor details and bank validation, probably 7 to 10 days is going to be a more realistic time frame. But if you just compare it to the examples I gave, I think that's still very reasonable, and particularly if the explanations are given upfront, that expectations are managed correctly from the outset, and certainly there should be no errors in the documentation, because obviously it takes time to send invoices back to service providers to get them corrected and to fill in the gaps if there are gaps. So hopefully that just gives some clarity on invoice process timing, what can cause delays, and the fact that a new creditor, a creditor that's not loaded on the system, does take longer. Now, I don't know how many of you are aware, but fraud is rife at the moment. And I would think that, Sadna, or maybe we can ask your team, but we are getting, many fraud instances per month where we are getting fraudulent invoices sent through to Trafalgar. And these come in the form of requests for change in banking details, where somebody has intercepted an email, they then Photoshop or they edit the banking details, they send us an email to say, please change the banking details. Some of them are very sophisticated, so it looks like the email is coming from the company concerned. And obviously, if we are changing bank details to pay expenses into a new bank account, which is not the correct bank account for the service provider, that is a way that fraud can be perpetrated. So we exceptionally on guard. We've got a very high alert status for fraud because it happens very, very often. And we're scrutinizing the documentation to make sure that it's accurate, that the risk of fraud is minimized. In fact, we've decided that each and every request for a change in bank details is actually fraudulent until proven otherwise, because that's how high the risk is, and that's how important it is to double check that it is actually correct. And as Sadna said, we go to the trouble of checking on websites, phoning the company independently, speaking to people different to those reflected on the invoice or on the email to make sure and double check and triple check that the bank account change and the bank account details are actually correct. So really, because of fraud, because of the values of the monies involved, and because of the responsibility we have to pay the costs correctly and fairly and accurately and ensure there's no loss of funds, that does take time. So that does explain a fair amount of the time that it takes to process these invoices, because literally we are checking each and every invoice 3 times to make sure that it's correct and valid and approved. And if there are changes in bank details or any information at all, we're double checking again, which takes time, and it explains the delay. So Shanith, maybe I can ask you to come in and just say, well, is there anything you'd like to add to that? But you've been directly involved from an internal audit team exactly on these checks and validations and checking the invoices are correctly paid. And maybe you just want to talk a little bit about the checks you're doing each and every month on a branch level to make sure that the branches are being responsible in the way that they process invoice payments. Shanith?
Yes, okay, thanks, Andrew. Yeah, we do. We actually check it on a daily basis. So what we check on QDocs is firstly to make sure that a valid report from our standard bank system is available for any of the creditors that have been loaded for the previous day. And we then go through all of the details to make sure that they have returned a valid response before the banking details have been loaded onto the system. And we then make sure that if any of the details have not returned a valid response or positive response in any of the fields that are required, that the creditor is deactivated on our system until we do have satisfactory confirmation of the validity of the account and the identity of the person of the account holder. And once we have that, then we can then proceed with the necessary payment process. But in terms of fraud, definitely a very, very high risk, fraud risk factor with regards to payments and changes in banking details. And our teams work quite hard to make sure that any changes have been validated by an appropriate person within the company that we pay. If it's not a company, an individual, sole proprietors and partnerships, a very similar approach is adopted where we'd phone the partner or sole proprietor concerned just to make sure that the change in banking details is legitimate. And yes, once all of that information is obtained, we do keep record of it on our systems just to make sure that our control processes have been followed. And we've had incidents in the recent past where we've identified incidents or we've identified instances of fraudulent requests to change banking details, and thankfully with our vigilant team we've managed to avoid payment to a lot of those creditors. So yes, our processes are definitely in place, and they're quite comprehensive, and it's just to make sure that we safeguard the monies that we manage on behalf of our clients, and also just to make sure that we safeguard ourselves against any potential fraudulent payments.
All right, thank you, Shanith. Then a question for Amina. Amina, all panelists need to talk this afternoon. So somebody's asking about progress payments. So in the event of a project, normally a bigger project where there are progress payments, or jobs where there's a deposit first and then a final payment, would you mind just commenting on how that's controlled and processed?
Yes, Andrew, we've got a system in place with our document management system as well to control all progress payments that are made against a contract. Examples such as painting contracts that should be in place. If an upfront invoice is sent through, normally for the deposit part of it, we will make payment of that and hold the rest of that payment. What we simply do at the start is account for it in the accounting system. So the project is then listed for that specific financial period, or depending on how the trustees would like for it to be seen financially. We then do progress payments based on either the invoices that we receive, and we ensure that there is a valid trustee approval for every stage of that payment. Most of the jobs, they do request for our maintenance inspectors to actually come out and have a review of the job being done, and to give them the heads up as to where the payment can be made as well. The trustees would then after supply us with the required stakeholder approvals, and we then process payments thereafter.
Okay, good. And I would just like to emphasize as well, with bigger projects, with bigger sums of money involved, it's highly recommended to have a professional project manager. So somebody who's got the necessary skills, the necessary experience to certify those progress payments, to make sure that the value of the work done is correct and that the payment is then validated on that basis. So things like construction projects, large waterproofing projects, painting projects, etc., highly recommended to have a professional project manager that then attends site meetings, is able to value the work done, and then give a valid progress payment certificate, as they call them. And that would certainly help the trustees and give them the comfort and the confidence that the progress payment was due. Also important that if there are any retainers, a retainer is a small outstanding balance that is retained for an agreed period of time. Often that's retained until the job is correctly approved, or otherwise, a settlement period at the end is allowed. For example, a large construction project, typically there's 10% of the project value is allowed to be paid sometime after completion. And that really just gives some time for any snags to be picked up, or snags then to be addressed, and that there is some funds that are held back to make sure the contractor is motivated to get that completed. So it's important just to bear that in mind. There's a fair point here that's raised by Zingapi Martin, just to say that, many service providers are small service providers. They do not have very sophisticated accounting systems. And, there should be allowances made for that. And, just making the point that it is helpful for them to pay as soon as possible. I think I did emphasize that certainly from our side, we are trying to process payments as soon as possible once the documentation is complete and checked and correct. And I would have thought that on average, invoices are paid within 3 to 5 days once the trustee approval is submitted for those payments. So I would think 3 to 5 days after final approval, and probably after 7 days from the invoice being sent through. That does rely on the trustees getting back to us promptly, because if it's not approved in a recurring payment resolution, we need to send the invoice off to the trustees by email, and we wait for them then to send back approval. So there is a dependency on the trustees to approve it, which affects the timing. We do ask them to do it on a 24-hour turnaround time. So 1 day would then be a delay due to getting external approval. But once that comes through, I would say, you know, a day or two to make that payment. You might be interested to know that across Trafalgar, we are paying, I think is it in the region of 15,000 creditor payments per month. Is that right, Sadhna? That's the sort of volume. And the other thing you might like to know is, I think Shanith talked about the document management system we use. That's a computer system that collects the documentation, and we use it in what's called a workflow format. So each of the steps we've talked about, that QDocs document system is actually supporting it. So the invoice is captured into the computer system, into QDocs electronically. All of those fields on the invoice Sadhna mentioned are actually captured into the system as index fields, so that you can search for that document by searching on any one of those data points. And the approval is sent from that system. The approval back from the trustees is captured into the system. And the reason that's important is that at the end of the year, we can press literally a button, and the document management system produces an electronic audit file. So in the electronic audit file, it's batching together all of the invoices paid through the year in an electronic file, which we can make available with a schedule to the auditors. And that goes a very long way to promoting a time-efficient and a cost-effective audit, because all of the source documentation is available to the auditors in that electronic file, which is very quickly produced by the document management system, because the invoices are processed through it. So hopefully that makes sense, but it also means that all the documents are electronic, they're all archived, they're all backed up, they're all secure, and the records then can't go missing because they're in paper form, they're not subject to theft or flooding, etc., because of backing up and the security protocols on the computer system. So there's a lot of securities and redundancy built up in that, which is really important to know in terms of the financial records and the financial management of these systems. So let me ask Karine, have you got any comments that have come up from your side during the discussion today that you'd like to add?
Andrew, yeah, financial management and budgeting and petty cash and things, that's not really my forte. But I do see a question on the questions site from Nico that asks, should retainer monies be put into a management rule? I don't want to suggest that, because management rules are very difficult, first of all, to make. You need a unanimous resolution to make a management rule. And also, if you have, on the other hand, it's also easy because any owner at an annual general meeting can place a restriction on the trustees or give a direction to the trustees. So if you want something like that to be a standard practice, you could just at the next AGM mention that as a direction or restriction to the trustees. But I still think it should be clearly thought about, because if you have to specify, is it now from now on for all projects? Is it just for certain projects? You will have to specify that very clearly as well. And yeah, as one of our clients said, you have to think of the contractor or service provider as well. They normally small businesses. They are dependent on the money or reliant on the money coming in after they've done the work. But yeah, a retainer sometimes is a good idea to make sure that everybody is happy with the work before the final payment is made. But yeah, it's just something that should be very well thought out before making such a decision. And that's basically all I would like to add.
Okay, thank you, Corinne. So look, our time is up. Dave, I don't know if you've got any closing comments you'd like to add. Do you unmute, Dave?
Sorry, everyone. Nothing further from my side, but if there are any questions or any tips or advice or anything that you want, please feel free. I think you've got Corinne's number and I'll help facilitate with the answering. Yeah, please let me know and I'm very happy to help out with any questions or queries.
Great. So I mean,
Thanks.
Dave's email address would be davidh@trafalgar.coza. Everyone's email address would be their first name, first letter of their surname at Trafalgar. So you're welcome to email any of us. And just from my side in closing, you know, I personally think caretakers can play a really important role in cost-saving measures at the building. And if we're able to save costs, it obviously reduces the levies that are required to cover those costs. How can you save costs? You can save costs by little things, and it's funny how little things add up. Making sure that there's no leaking taps, that taps are not left running, that lights are turned off during the day, that workmanship done on site is done first time right. Many of you will meet contractors on site, you will supervise their work, you will sign their job cards, etc. Make sure it's done right, because then you'll get a durable result that ultimately saves money. So you all have an important role to make sure that money is spent wisely, it's spent effectively, and that will save money, which ultimately reduces levy income. Also looking after equipment on site, you know, making sure that the building equipment is serviced, that it's used correctly and it's used efficiently and it's used professionally. That all like kind of prolongs the lifespan. It avoids unnecessary wastage of costs, getting new equipment when it's not necessary. And another important example is cleaning materials. You know, I've seen many buildings where the cleaning materials are not correctly measured. They're not correctly mixed. They're mixed too strong. And that obviously wastes costs as well. So really important just to be meticulous, to check that the right concentrations are being used, that the necessary staff have been trained and are using it correctly. Do the spot checks, make sure that the measures are there, make sure that any surplus chemicals which have not been used is stored properly, is sealed properly, is out of the way, that it's out of the sun. All those little things make a huge difference in maximizing the use of the materials on site and prolonging their lifespan, in saving costs. And I'm sure all of that will resonate, and certainly your roles are critical in that regard, and the best caretakers certainly take an active role in that. So thanks once again for attending. We appreciate your support, your involvement. Hopefully you found it informative. Many thanks to my fellow panelists, and then we look forward to seeing you next Tuesday at 3 o'clock again to discuss the topics of arrear levy collections. So good afternoon, everybody, and I hope you have a nice evening. Thank you very much indeed.
Thanks,
Thank you very
everyone.
much.
Cheers.
Bye.